viewers, in this video we will be discussing the Unit 5 of Module Management Accounting and Applied Finance offered by CA Australia and New Zealand. In this video we will be discussing the budget process, which is very important, and the budget methodologies. We have received quite a couple of questions in the past exam papers from the budget methodologies, developing a budget as well. Let's start with the Unit 1. The budget process, and the budget process is actually it's devised by strategic and operational plan. So with these strategic and operational plans, what does we mean? We mean it like this: sets the organization. The very first thing that organization is doing is sets out goals and objectives and outlines strategies to achieve them. Like first of all, the organization is doing it's setting up goals and objectives so that they can how they are going to achieve their goals. That's how simple it is. Then what they do, the step that they do is financial forecast and analysis. That's a high level thing. What does that mean actually? That is actually, I'll be just giving you a little bit of example and things. When an organization is setting up organizational strategies, so it is how strategy is implemented. And then yearly targets or assumptions, that's called the business plan. But the budgeting process and the financial thing is, it includes the operational budget, like the operating budget, cash budget, and balance sheet budget. When we merge these budgets, then we make a forecast. The annual budget detail level. So what we do is in the operating budget, sales and revenue, cost of sales, like all the cost that comes in the operations of the organization. Sales and revenue, cost of sales, direct material budget, direct labor budget, direct overheads budget, overhead expenses budget. This is operational things. These are operating budget. As you can see in this annual budget, third point is operating budget. The cash budget is cash receipts, cash payments, and bank balances. Balance sheet budget is assets, liabilities, and equity. Okay. So what the organization will be doing in this detail level is they set the targets at the beginning of the planning period, and the key management control tool, they also set up a couple of tools so that they can achieve their operational budget, cash budget, balance sheet budget. Okay, now if we have gone through this process, then what we come across is there is another thing, that is the factors that need to be considered while preparing these annual budgets. What are these? There are few are the internal factors, there are few are the external factors. An organization historical performance. Historical performance is the past data that we have already got from the financial data or the organization. If they have performed, so how well they have performed, we can analyze it. For example, an organization that has consistently generated a gross margin of 25% over the past 5 years would need to substantiate any deviation from this margin in the budget. If an organization has achieved 25% of their gross margin budget, do we have to consider any kind of deviation, any factors that might affect that 25% reasonability, or can we say no, we can keep the 25% as it is, and we can change a couple of more factors after that? Is that the historical performance? This is the kind of factor that we need to consider, historical performance. Now come to the seasonality. What does that seasonality mean? Weather. The weather is also definitely a season. Weather is only the one thing. For example, beer or ice cream sales are budgeted at higher levels in summer month based on non-sales pattern. So beer or ice cream sales are budgeted at higher level in summer. In summers, we can see the season is summer. Okay. In that summer factor, we can say if we are including the summer, then it means in that summer we might expect a little bit higher sales as compared to the winter. That's the factor that we need to consider. New products, services, or markets. Where an organization is planning to introduce a new products or services, it may be difficult to budget for its performance because there is no historical context. Okay. That thing also we have to consider. If our organization is introducing a new product, a new service or market, then it means we don't have any idea. We can't even predict that budget. Okay. Um, and the new investments. New investment is the impact on the upcoming budget. New investment, it means if an organization is doing a kind of joint venture with any bigger organization, so it means they will be getting a new upcoming new investment in the organization. So examples include manufacturing organization that invest in a new plant and equipment to improve productivity and cost structures. It means what impact they will bring. So this is also a factor that can influence our budgeting making decisions. So these are the key factors. I'm telling you the key factors. Industry developments and changes. So if is there any technological development in the industry, if there is any there are a few kind of any kind of changes that's happening in the industry, it means we have to consider that thing. Okay, that is also a key factor to consider. Economic trends and conditions. If the economic trends and conditions means like it is also important to consider general economic and social trends such as GDP growth and wage and general price inflation forecast. Even you can say how this pandemic has hit our organization. So we can consider that factor as well. That's the economic trends and conditions that will also impact our budgeting or the forecasting and analysis at a very aggressive level. So we have to consider these factors. So what I have told is what are the key factors that needs to be considered? These are the 6. Historical performance, season, new product or services, new investment, industry development and changes, economic trends and conditions. If we pass through that thing, then definitely we have already made a budget, and then what we have done, we have received the actual performance. So the actual performance, what actual performance is there might be a difference, definitely, that we will call a variance. If it's a variance, then we will calculate the what kind of variance is that, but in next chapter. Don't worry about that in now. And for that actual, based on that actual performance, what we do, if it's a quarterly, then we devise the rolling forecast budget, continuously adding a new period to the forecast at the same rate as time is passing. I'm giving you an example in this way. Is here you can see the year X, quarter 1, 2, 3, 4, and the year X plus 1. First review. First review is like quarter 1, 2, 3, 4. We have made that. Okay. And then what happened is we have year X plus 1 as a quarter 1 that we have thought, we're thinking like it might be the projection will be, or the budget is for quarter 1 is that. But now what happened is when the actual data, you can see the light gray box is actual. So now we have received in the second review, we have received actual data for quarter 1 and year X. That's the actual data based on all the factors or all the consideration that we have to take into account in the quarter 1, and then we have to predict all the after quarters like quarter 2, 3, 4 for year X and quarter 1, 2 year X plus 1. Now when we go to the year 3, then we got the actual result of the quarter 2 of year X. Now what we will be doing, we'll be changing after those 5 quarters. So this is a rolling forecast. You have to, this is an example of a rolling forecast, continuously adding a new period. We are continuously adding a new period to the forecast at the same rate as time is passing. Okay. Now what we're doing, the funding requirement. The funding requirement actually is to achieve the strategic goals and objectives. So it means either we are putting adequate amount of funding to make these goals, to make the organization goals and objectives achievable. So we have to ask this question. Now I am giving you another thing is, so suppose in the financial forecast analysis, if we have to adjust strategies based on financial forecast, if our financial forecast is not up to the mark that we were thinking according to our strategy or goals, it means then we have to adjust it. If we have to adjust it, then we will start to the again to the same process. Okay. Now let's suppose if our annual budget is not working and it's not up to the mark, then what we will do? We'll do adjust the strategies based on detailed budget. Okay. We will adjust our strategies based on detailed budget and we will start from that process again. Okay. Now, that's a very important thing is the arguments against traditional budgeting, because the budgeting is a very complex process. Okay, we do have 9 arguments which we say drawbacks as well. These arguments are actually against the traditional budgeting system. The number one is preparation time. Okay, it takes a lot of time, demands an inordinate amount of management time that could be better employed in other activities. Okay, we sometime in the bigger organization we have to hire a couple of people. We might have to hire one person who might be responsible for budgeting in that particular time period, or maybe for more time. So it's a preparation time. Quickly out of date. We normally hardly use that budget, probably for just for 1 week, 2 weeks, just to report the management. Okay, the budgets often become quickly out of date, particularly in fast changing business environments, rendering them ineffective as a control mechanism. We can't keep control on that because the days change, so the data change. Okay, so we can't do that. We can't make it up to date on every day. And the third point is focus on achieving short-term financial targets. Short-term financial targets, rather than on key value creation drivers for an organization. What does that mean? So it focuses on achieving short-term financial targets. By preparation of the budget, what we can do, we can achieve short-term financial targets. It normally focuses on 1 year. It is reinforcing the hierarchical structure. It normally focuses on a hierarchical structure which stifles in innovation adaptability. Because definitely in the hierarchical structure, we will be getting the orders from the upper management. We are not using our mind. The employee is not using their mind to think differently and make a little bit of contribution to the organization so that they can implement those strategies and might be getting really good results. It inhibits creative thinking. As in the previous point we have said, we have to get the orders from hierarchical structure, so which inhibits our creative thinking. It reinforces the silo mentality. And resources allocation decision becomes entrenched over time. Okay? It perpetuates resources allocation decisions over time. And it encourages dysfunctional behavior. Okay. Now we move on to the next slide, which is a really good example of how we can the business planning, including budgeting and forecasting. How we do the business planning. How we do the business planning. The first step that we will be doing is the budget process is identify and apply the most appropriate budget methodology, which is very, very important. Identify and apply the most appropriate budget methodology. And effective planning and coordination. Oversight, review, and communication. How this process comes into be. First of all, we identify what methodology we have to use, what is appropriate methodology that we will be using in the budget. And then what we do, effective planning and coordination with the team so that we can make it, we can implement that. And then we oversight and review and communication so that we can devise the actual budget. Okay, the approved final budget. Then the step has come, the approved final budget. The effective planning and coordination. What does that mean? Effective planning coordination. We'll be discussing in details later on. But first of all, we will be using the methodology. What is the appropriate methodology that we will be using in this process? So the first is zero-based. this is a methodology that we'll be using as a zero-based. Zero-based is actually activities justified as if budget prepared for the first time. The budget methodologies are a very important topic. Okay, you have to keep in your mind, maybe any question or any short question maybe comes into your exam, so just keep in these things, that what points I'm giving you, these points you have to keep in your mind. If it's the project says it's a new project, so it means it's a zero-based methodology. New product, zero-based. New business stream, zero-based. Then significant market changes occur. Significant market changes occur, zero-based. When needing to the budget process, like we want to renew the budget process, so it means zero-based. We are changing the budget process, zero-based. Now the second is incremental. What does that mean? Incremental is just based on the previous one, we just apply a percentage. It's incremental based on previous periods figures with the percentage adjustment applied. Okay, when we will be using, just keep in your mind for exam. In a stable business environment, if the business is stable, then we can use the incremental. There's nothing has been changed, so we can just apply the percentage and we can say, okay, this is incremental budgeting. When experiencing established and expected trends that are expected to continue, just keep in your mind, incremental is already, there is nothing is changing. Okay, it means if a business is experiencing established and expected trends that already expected, we can say, yes, the sales has been increasing 10%. Yep, that's good, we can apply it, it's incremental. Okay, now come to the third one, is top down. Amounts determined centrally at senior level in line with strategic plans. So what in the top down, what we'll be looking for in the exam is in smaller organization. Keep in your mind, in smaller organization, you will be applying top down methodology where there is a large degree of senior management control, because in the smaller organization there is not a kind of bigger hierarchy, but what it is, there is one or two person who might be managing the business. So it means top down. You will be getting the instructions from the top management to the down management. Okay, where there is a large degree of senior management control, where decision making is highly centralized, where the decision making, everything is being done by that owner. Okay, that's the top down. Now there's another one just opposite to that, it's a little bit of bottom up. What's the bottom up? The previous one was small organization, this will be for large organization. Okay, previous one was the top down was for centralized decision making, this will be decentralized decision making. Okay, and the bottom up also will be, because in the top down it might be just one organization, there might be just one franchise, there must be one segment, but in the bottom up it will be where there is a geographic separation between different parts of the organization. If like the one franchise in Adelaide, maybe one franchise in Alice Spring. So these two have the centralized bottom up approach. Okay, they can do their things autonomously, but they have to get the a kind of strategic planning from the upper management, but it's not in the day-to-day activities where there is a geographic separation between different parts of the organization. Okay, now come to the last one. Last one is top down and bottom up. Now what they're doing is a little bit of mixture. Top down and bottom up. Operational managers prepare budgets based on strategic plan from senior management. What they do, they get the direction from the senior management, but they prepare their own budgets based on all those strategic plans. Where senior management maintains control, senior management is making control, but provides lower level management levels with a voice so that they can be heard of. Okay, in a medium to large organization, this can be found only in medium to large organization. So as you can see, the top down is for smaller organization, bottom up is for larger organization, the top down is for medium and large organization, medium to large organization. Now, effective planning and coordination. Effective planning and coordination. What does that mean? So it is actually, so what we will be doing in this is, just give me 1 second. First of all, we will be doing design the budget process. We will be designing the budget process. What will be the budget and how we'll be doing the things, and then timetable and milestone. Okay. Then we will assign responsibility. So this is actually what we're doing. Before we have set up a methodology. First of all, we have set it up the methodology, whatever we will be using the methodology. Then after that, we have to come to the next step. That is step 2 in the budget process, effective planning and coordination. Now what we're doing, how we are going to implement that budget methodology. Okay, what will be the time frame, like designing the budget process, what will be the process we will be implementing that post zero based methodology. Then timetable and milestone, how much time we need to require. Okay, and what will be the assigning responsibility. That's it means who will be the manager responsible for that zero based methodology. And documenting and communicating guidelines, what will be the documents that we will provide to the lower level management so that they can implement and we can communicate with them based on those guidelines. And automating the budget data, how can we make a kind of budget data to make it automate, so that we can say we just run this formula, we can run this Excel spreadsheet, and then after that we just get a data that can give us what we want. That's simple. And now oversight, review, and communication. That is very important topic. That is very important area after devising all this methodology and the planning. Then what we do is oversight, review, and communicate. Involvement and commitment of senior management. Here we need the involvement and commitment of the senior management. Why we need that? Because whatever we have made a plan and coordination, we have to get a very senior advice from our senior management so that we can say, yes, we are going on a right track. Then what we do is they approve the final budget. Now, how we develop a budget? That is a very, very important thing, is how can we devise a budget, develop a budget. In the step 1, it includes 5 steps. I'll be telling you what is the step 1. Step 1 is identify key factors. Key factors in developing a budget or forecast includes, first of all, we have to identify what is our strategy. Okay. And then we will be using our management or CEO guidelines, what they have told to us, what is their objective, what are the goals. Okay. Then if we're using the historical performance of the organization, then yes, we have to consider that. If we are using the seasonality, we have to consider that factor. Whether, because these are the factors that we will be using, factors affecting our decision. This is the key factors in developing a budget or forecast include. Okay, this has already been discussed. Historical performance that we will be discussing, we have discussed. Seasonality, new products, services, or markets, new investments, industry developments and changes, economic trends and conditions. If you have considered these things, okay, then what you will be doing, then we will be coming up to the second step, what we will do. Okay, the second step is actually establish any key differences to the latest current period forecast results. We just need to critically evaluate, is there any key difference between the current period and the forecast or results. Okay, providing analysis of the previous budget is not as relevant. Providing analysis of the previous budget is not as relevant, because the previous budget that we have made before, definitely it's not relevant now. Now the step 3 is we will be applying key factors and performance expectations and identify differences. How are we going to do it? We will be applying key factors identified in step 1. What are the key factors that we have identified in step 1, and establish any items that are inconsistent in step 2, because in the step 3 what we'll be doing, the factors that we have identified in step 1 and the data we have collected from step 2, we are just matching it, whether is there any link between data step 1 and step 2. Okay, is there any inconsistent thing that we can identify? Ensure each facet of the budget is consistent with the underlying strategies. Whatever the strategy has been built up, we have to make a kind of consistent relationship or underlying consistent relationship in between the objective and the strategies. Step 4 is now compare the identified items. That whatever we have identified in the step 3, we have to compare it and assess the extent of any differences. Determine where the assessed differences require investigation or adjustment. Determine where the assessed difference require investigation or adjustment. Now in the step 4, what we have done is we have to determine or we have to assess whatever the difference that we have investigated or whatever the adjustment that we have. Then we're just determining the differences and we are investigating the adjustments. Okay. Now in the 5th step is further investigation of inconsistencies between strategy and budget. Okay. Adjustment to provide a greater level of accuracy, adjustment to reflect change, circumstances and key factors. Now, very easy thing is developing a budget is, first of all, you have to identify these factors, then you have to get the data in step 2. In the 3rd step is you have to compare any inconsistent items in step 2 and step 3. Okay, then you will be comparing this data with the difference that the investigation that you have made, why these inconsistencies has coming through. Then you will be further investigating those inconsistencies that you have identified in number 4, step 4. Then you will be identifying the circumstances and the key factors. What adjustment do we need to make? Okay.